The financial world was stunned when two major banks, Silicon Valley Bank and Swiss Bank, collapsed in an unprecedented event. The fallout from these failures sent shockwaves through the global economy and raised questions about the stability and oversight of the banking industry. In this in-depth analysis, we will explore the truth behind the collapse of Silicon Valley Bank and Swiss Bank, examining the factors that led to their downfall and the lessons that can be learned from this financial disaster. Silicon Valley Bank was a renowned American bank with a strong focus on technology and innovation. Founded in 1983, it was headquartered in the heart of the tech industry in Santa Clara, California. SVB specialized in providing financial services to high-growth technology and life sciences companies, venture capitalist firms, and private equity firms. Over the years, it had built an impressive clientele and established itself as a major player in the world of technology finance. Swiss Bank was one of the oldest and most prestigious banks in Switzerland, with a history dating back to the 19th century. It had a global presence and offered a wide range of financial services, including private banking, wealth management, investment banking, and asset management. Swiss Bank had a reputation for its conservative approach to banking and its strict adherence to Swiss banking secrecy laws. Both Silicon Valley Bank and Swiss Bank were severely impacted by the global economic downturn. As businesses and individuals struggled to cope with the economic fallout, default rates on loans increased dramatically. The bank's non-performing assets surged, leading to reduced profitability and a decline in their asset values. The economic downturn exposed weaknesses in the bank's business models and risk management practices. Silicon Valley Bank and Swiss Bank had both invested heavily in high-risk assets, including technology startups, leveraged buyouts, and complex financial derivatives. While these investments had the potential for high returns, they also carried significant risks. When the market turned, the banks found themselves saddled with a large number of underperforming and illiquid assets. Both banks failed to adequately manage their risk exposures. In the case of Silicon Valley Bank, its focus on the technology sector meant that it had a highly concentrated portfolio, making it vulnerable to industry-specific downturns. Meanwhile, Swiss Bank had expanded its investment banking and trading activities, which exposed it to a greater market risk. The bank's risk management systems were unable to detect or mitigate these risks effectively, leading to substantial losses. Regulatory authorities in both the United States and Switzerland were criticized for their failure to identify the looming risks at Silicon Valley Bank and Swiss Bank. Critics argued that regulators had become too complacent, relying too heavily on the bank's own risk assessments and failing to conduct adequate independent evaluations. In addition, some argued that the regulatory environment had become too lenient, allowing banks to engage in excessive risk-taking. Investigations into the collapse of Silicon Valley Bank and Swiss Bank revealed instances of fraud and mismanagement at both institutions. At Silicon Valley Bank, executives were found to have manipulated financial statements to hide the extent of the bank's losses. In Swiss Bank's case, rogue traders had engaged in unauthorized and risky trading activities, resulting in massive losses that were hidden from the bank's management and regulators. As news of the bank's troubles became public, depositors began to panic and started withdrawing their funds en masse, resulting in a bank run. This massive outflow of funds exacerbated the liquidity problems faced by both Silicon Valley Bank and Swiss Bank. Unable to secure additional funding, the banks found themselves unable to meet their obligations to depositors and other creditors. In an attempt to stem the tide of the bank run and prevent a complete collapse, governments and central banks in both the United States and Switzerland stepped in with emergency measures. Despite these efforts, including capital injections and temporary guarantees for depositors, the scale of the problem was too large to be contained. Ultimately, Silicon Valley Bank and Swiss Bank were declared insolvent and forced into bankruptcy proceedings. The collapse of Silicon Valley Bank and Swiss Bank sent shockwaves throughout the global financial system. The sudden failure of two major banks led to a loss of confidence in the banking sector, resulting in tighter credit markets and reduced lending activity. The knock-on effects rippled through the global economy, exacerbating the existing economic downturn and making it more difficult for businesses and individuals to access credit. In the aftermath of the collapse, investigations into the bank's activities revealed numerous instances of fraud, mismanagement, and regulatory failures. As a result, several executives from both banks faced criminal charges and numerous lawsuits were filed by shareholders, creditors, and depositors seeking compensation for their losses. The collapse of Silicon Valley Bank and Swiss Bank also led to widespread calls for stronger financial regulation and oversight. Policymakers around the world introduced new measures aimed at improving transparency, risk management, and capital requirements for banks to prevent similar crises in the future. The collapse of Silicon Valley Bank and Swiss Bank highlighted the crucial role that effective risk management plays in maintaining the stability of financial institutions. Banks must continuously assess, monitor, and manage their risk exposures to avoid being caught off guard by unforeseen events or market shifts. The failures of these banks underscore the importance of diversification in banking. By concentrating their investments and lending activities in specific sectors or asset classes, banks become more vulnerable to downturns in those areas. A more diversified portfolio can help protect banks from significant losses in any single sector or asset class. The collapse of Silicon Valley Bank and Swiss Bank demonstrated the need for robust regulatory oversight and international cooperation in the supervision of the banking sector. Regulators must be vigilant in identifying potential risks and ensuring that banks adhere to the established rules and guidelines. The scandals that emerged from the collapse of the two banks highlighted the importance of transparency and accountability in the financial sector. Banks must be open and honest about their activities and risk exposures, while executives should be held accountable for their actions and the overall health of their institutions. The collapse of Silicon Valley Bank and Swiss Bank serves as a stark reminder of the potential consequences of unchecked risk-taking, inadequate oversight, and the interconnected nature of the global financial system. While the financial industry has taken steps to learn from these events and implement reforms, it is essential to remain vigilant and continuously adapt to new challenges to prevent similar crises in the future.